Good evening and welcome back to Be Rich. Today I have my good friend and nephew Shashwat Swaminathan, and he is going to talk about macro hedge funds. And so let me have a discussion with him on macro hedge funds and let us see what he has for us. Yeah, Shashwat, up to you.
So first off, I wanted to get a fair idea of what is a hedge fund first, and what's the difference between a macro hedge fund and a hedge fund. Yeah.
Okay. A hedge fund is one in which there are limited partners and people invest in that fund.
Limited partners meaning?
Normally you have 20, 30 partners. Now they have different versions of that. They have become bigger versions. I'm giving you a simplistic.
Right.
There is a minimum amount each person has to invest,
Yeah.
which will be $1 million. So normally it will be 20 people putting $1 million or such. But this is how it started. Today it has become complicated. It's gone to billions of dollars. So institutions invest in hedge funds. Normally hedge funds started in the 1960s. It started in 1960s. It started with a pool of investors who are high net worth individuals who pulled in minimum amount.
Right.
And these hedge funds started to invest and trade. There are two types. One is Warren Buffett's hedge funds, what he calls as partnerships. There was no hedge fund those days, in which he did value investing. He did not use leverage. He did not use leverage to magnify the returns. And he made money. He said over and above the treasury rate. So up to treasury rate, he would not take any commission. Suppose treasury rate is 6% those days.
The risk-free rate.
The risk-free rate is 6%. Suppose he made 20%, 20%. He would keep on that 14%, he took 20% of that as fees. And he did not charge a management fee. This is how he built his business. Till he bought Berkshire Hathaway and decided to dismantle his funds. This is how hedge funds started. On the other spectrum is somebody like George Soros.
He runs used to run a macro.
He used to run a macro funds. He also started in the early 70s. It was called the Eagle and Double Eagle Fund. And when they took it out of that brokerage, it became Quantum Fund. In that fund, it was registered overseas. You had to hit $1 million. I don't know the exact number now. $1 million.
In assets under management.
Each person has to put up $1 million.
Okay.
You will have 25 million. But you had given him the right to leverage also. So what he would do is he would buy an asset and leverage that asset 3, 4 times, 5 times.
Right.
And use that money to trade. The problem in leverage is, suppose I have got 100 rupees of my $100 and it leverage it 10 times. Then I have got 1,000 plus 100, $1,100 and I pegged it on an asset. If the asset moves 10%, I lost my entire $100.
Right. Yeah.
Because people will call the chips in.
Yeah.
And the equity will get reduced to zero. Now these guys don't do 10 times. They do 20, 30 times.
And it's legal for them to do
It's illegal. So that's why high net worth individuals have to get in.
Right.
So if the fund moves 5%, you will get wiped out.
And when you do get wiped out and you have to pay back your interest and debt.
No. The debt they will collect. The debt he'll collect.
So he'll never let your losses cross beyond your principal.
Unless there's a meltdown.
Okay.
Now there was a fund called the Long Term Capital Fund, LTCM. That's a major landmark in finance. They had built the Black-Scholes method. Out of two people, one of these guys was a part of that fund. He was a Nobel laureate. And the idea was that they had designed a system by which they thought the system told them that the Russian bonds will never fail.
Will never fail.
And the Russians defaulted.
Which year was this?
I think 90.
Okay.
When the Russians defaulted.
So this is Soviet era?
No. After the Soviet era.
So which year was it?
This was in 1998, the post-Soviet Union era. The Russians defaulted in 1998 and this fund went kaput. So they had to look for bailouts.
Right.
Soros did not bail it out. Warren Buffett did not bail it out. And finally the Fed had to interfere because the whole system would have collapsed. They had taken so much leverage. And then it was slowly unwound and people got most of their money back. The people who took the equity got wiped out in a single day. And the banks had to if they had pushed the button on that day, they would have taken an haircut. That was one time when the markets the default meant the bond yield. Normally, if your bond doesn't default, if bond is valued at 100, it will come to 98.
Yeah.
But a bond which is valued at 95 comes to zero immediately. The entire fund got wiped out.
Right.
The equity got wiped out. People got their money back. The lenders got their money back over a period of
lenders.
time. The lenders. The equity guys got wiped out and they became bankrupt. So this is LTCM and what leverage can do. There are some people like Stanley Druckenmiller and George Soros, and there are many. I am just giving you names.
Bacon.
These guys know repeatedly how to make macro
Moves.
In this, George Soros is famously said that if you are playing tennis, you should have 3 balls in the reserve.
Right.
So if you lose 2, you still have 1 to finish the game.
Yeah.
So the whole, according to Soros, what I understood from what he said, is the amount of risk you are willing to take. You don't put everything in one trade,
Right.
and you don't get trapped. So there are 2 things in a hedge fund: the ability to get the calls right,
Yeah.
the ability to stay calm, the ability to observe pressure, and the ability to arrange liquidity. Remember the famous British pound case?
Yeah.
When Stanley Druckenmiller said, we'll take this position, he said, increase the position 10 times.
Yeah.
And he went to sleep and came back next day and raked in $1 billion in a single day.
Yeah.
The first $1 billion trade. So that is the kind of nerves you should have.
Right.
And if it goes against you, you should know how to get out.
You don't engage in sunk cost fallacy.
No, you don't. The first known guy for me is Cantillon. I have discussed that with you on what he did with the Mississippi bubble.
Right.
If you study what Richard Cantillon did 500 years ago, that's exactly what a hedge fund manager does.
Yeah.
That is the hedge fund manager.
So
But the problem in today's hedge funds is you charge 2% management fee plus 20% on
whatever profits
you make. So basically 22%. And the market, normally what happens, unless you are a genius, you cannot beat the market because the market is so big. So you get a middling performance if you put fees. That is, if you are tracking the equity index plus dividends cannot be beaten by a mutual fund. Same is the problem for a hedge fund because it will take 20% of the profits. 2 and 20 will make sure the investor does not get the return that an index will give. In America, there's a bond index, there's a housing index, there is a stock index. For everything, there's a dollar index.
Right.
So beating the index is the biggest problem for these hedge fund managers.
Right. So coming down to a hedge fund, so there is no actual defining guideline as to how a hedge fund is supposed to operate. Each hedge fund can do what it likes.
I can do what I want.
So
There's a guy called Bill Huang who went bankrupt now, Archegos.
Yeah, Archegos Capital.
He was doing all sorts of crazy
leverage.
Right.
He ran a home office or something, right?
He was fined. So he made a home office into a hedge fund.
Right.
So a hedge fund is basically a fund in which you have limited equity and you use leverage to magnify your returns. But the risk is when you try to magnify, the losses also it cut both ways.
Yeah.
It losses also magnify. In case of George Soros,
Right.
since he didn't have a stable income and he didn't have a stable background like Warren Buffett, this was his only chance.
Right. Right. So coming down to how hedge funds operate these days. So in the past 10 years, we've seen a low interest rate regime, especially in the Western countries. So a lot of these hedge funds have been loading out on tech stocks. So they've been buying up tech stocks, and recently they've gotten a battering. So most hedge funds on average are down 5.6% because of interest rates being jacked up and tech stocks getting beaten up. And at the same time, what's interesting is macro hedge funds have done very well. So you have your Bridgewater by Ray Dalio and Bob Prince, which is up 21.5%.
Because he said this would keep coming for the entire world.
Right.
So somebody who knew that inflation was not transitional, was not transitionary, would have made 22%.
Right. And the predominant bet, I mean, as you said, he made a predominant bet on inflation, one. But also, how did he stay afloat in the past 2 years when you've discussed this from 2020, where you said this will build up and we'll see something like this coming, when we saw pent-up demand coming out after lockdown?
He was in a lot of cash, lot of gold, and some emerging stocks. So most of it was in gold and cash.
So he was sitting on a war chest.
And he really, if you go, today is overperforming. The previous 2 years he would have underperformed.
But my question is, how did he survive those 2 years?
Very difficult. There was a lot of funds outflow.
Yeah.
So that's why Buffett gave up.
Fund managing.
And that's why Soros made it into a family office.
Right. And what is the difference between a portfolio managing service and a hedge fund, apart from the leverage? leverage.
That's the big difference.
Okay. So apart from the leverage, there is no big difference.
No big difference.
Between a portfolio management service and a hedge
No,
fund.
no, there is no big difference.
And what's the difference in, and what does the hedge fund scenario look in India? Do we have hedge funds?
No,
as such?
India, the tax treatments are, taxation is a devil. So you cannot run a proper hedge fund. You can have informal hedge funds. Formal hedge funds are not
So
possible.
what do you mean by informal hedge funds?
I can run a hedge fund myself for myself without any,
That is, you'll be managing your own money
my own money.
with some leverage if you choose to do so.
I choose to do so.
That would be an informal hedge fund.
That's an informal hedge fund.
And you could manage for, let's say, 10 or 20 people.
On their own account, I can manage.
Right. And that would be an
They will be managing. That's an informal hedge fund. That's an informal hedge fund.
Right.
But the other guy cannot blame me.
Because there's no legal document stating anything.
Yeah, because SEBI will make it sure
Yeah.
that I cannot be an organized hedge fund.
And you don't see hedge funds propping up anytime soon in India.
I don't think so. I think even mutual funds the active mutual funds will evaporate because SEBI is trying to protect the investor.
But in the wrong ways.
In the wrong way by saying that this is too risky for you.
Right.
It wants the mutual fund. It wants to decide where the mutual fund guy will invest.
Right. And
See, it says a large cap fund can invest only in the top so many so and so stock. A mid fund can only invest in so. Then how will that guy outperform?
Right.
If I'm going to buy only the top 100 stocks,
yeah.
then I can buy the Nifty and the next Nifty and sit on it.
Yeah.
So it's being stupid. SEBI is being penny wise pound foolish. It thinks by qualification and definition of net worth, required net worth.
Yeah.
By definition of required net worth and by qualification, it can protect the retail investor.
Yeah.
What this will do is there will be a lot of scamsters running parallel schemes, informal schemes.
Willing to take on more risk.
They will take more on risk and they will lose their entire principal, lose pant, shirt, everything.
So you
There
rather
are several such schemes running in Tamil Nadu as I speak to you.
So you rather have a legitimate fund which takes higher risk, where investors can choose to opt into that, rather than having peddlers, scammers, and peddlers peddling funds which take that risk and promise that return.
Yeah.
Final question: what happens to all the pension funds in the US which have invested in funds which have invested in funds? So the fund of funds.
Fund of funds means you will pay it twice.
Right.
It will be informal.
Yeah.
And pension funds, what you have had in America and the West is financial repression. And you are having it in India also. That is the rate of inflation over a long period of time
is higher
than the fixed
nominal
deposit rate or the rate at which the Reserve Bank lends or the Federal Reserve.
So you have negative real return.
You have negative real return. Whereas pensions have to pay a positive return.
Yeah.
We are forcing the pension funds to take a bigger and bigger risk, and it will backfire badly over the long term.
But what's the solution to saving these pension funds? Are they a good idea in the first place?
I do not know. I don't want to comment. I don't have a pension fund. I'm 55.
Yeah.
I don't have a pension fund. You know my finances. I don't have a pension fund.
Right.
I rather manage my own money. I don't think they are efficient. I don't think they give sufficient protection, and they will not. Most people who have pension funds will be disappointed. That means they'll have to work longer and longer to save for retirement.
So as
this is a problem, is because the central bank thinks it can postpone you can never have a recession. See, one thing I agree with Austrian economics. If you have a boom, you have to have a recession.
Yes.
Good times have to be followed by bad times.
You have to correct the excess.
You have to correct the excess. What the central bank and the politicians have been trying for the last 25 years.
Keep the excess, but the growth will match to pick up with
So by making money cheap, they think they can continue to grow forever.
And make up for the excess in real terms.
Make up for the excess. But what do? They devalue the level of money.
So at some point, so that's where Keynes comes in, because he says the aggregate supply curve is straight here, but it's vertical.
I sent you a graph from Ray Dalio.
Yeah.
Which says and with that graph I can say for India that even if I have made a 8% return or a 9% return on my money from 1980 till today, gold would have been a better investment.
Right.
So people can argue ITC would have given better return. But will you take all your money and put it in ITC? I won't do it myself.
Yeah. So from what I see.
So this is a problem of financial repression by.
Right. But my point being that what is the difference between individuals choosing to engage in their own financial security for the retirement and having a pension fund do that in collective?
Because most people won't even know managing money is a very complex thing.
That's what I'm saying. So isn't a pension fund a reasonable alternative?
I don't think so because it doesn't pay the return that is required. See, because you work for lesser number of periods and you live longer.
Yeah.
In America, everybody works till 70.
Yeah.
In India, nobody works beyond 55, 56.
But the tax benefits you get from pension funds, what about that?
See, taxation is different from you don't invest because you get lesser tax.
But if
Tax
you were
is a
to,
consequence of doing well. So if I'm going to invest for the sake of tax, I will neither get investment return.
but
nor
what
will I-
about your capital gains tax?
You have to manage it. Soros has managed it. Buffett has managed it. You can also manage it. If you are smart, you can manage it.
But as I understand it, your 401k is not non-taxable the investment.
Yeah, but 4001k, I would rather put it in the Vanguard S&P 500 and go to sleep.
And pay the tax.
And not pay the tax. Now, as long as it's in 401k,
Yes.
I don't have to pay the tax. I can postpone the period time.
Yeah.
I have to pay. The longer I stay, people talk to me about capital gains. Only if I sell, I have to worry about capital gains.
As long as it's on paper, they can't do anything
They
about
can't do anything about it.
But how do you suppose that someone in their you sell it when you have to retire?
I mean, if at all I have to retire,
Yeah.
if I need the money,
And you pay the tax then?
you pay the tax then.
Okay, well, that's all I have for you.
Thank you. Thank you very much. Thank you for watching Be Rich. If you like this video, kindly hit the subscribe button and turn on the bell notification. If you do not turn on the bell notification, you will not be notified every time we put a video. Once again, I thank you for your support to Be Rich. It's a great privilege and honor that so many of you in thousands have subscribed to my channel and have supported me. I have written 2 books in English, The Alchemy of Money and Ordinary Stocks, Extraordinary Profits. These books are published by us and are ready. If you want to procure a copy, send us a message to the WhatsApp number given below and my team would respond to you. If you want an Amazon Kindle copy, you can click the link below. Finally, those who wish to consult with me can send a mail to berichenglish@gmail.com. Once again, I thank you for your support. If you like this video, press the subscribe button of my channel, hit the like button and turn on the bell notification.